All right. Good morning, everybody. TGIF, huh? Friday the 13th doesn't disappoint. Commodities got a little bit of a bid with the actions in the Middle East. Crude's been a sell the rip. This is not new. Still going to be sell the rip. Might have to adjust your time frame a little bit. And gold was already bid, so now it's just more of a bid, which makes gold a short-term likely pullback, right? That it's getting popped with the rest of commodities, but it's likely going to suffer with them as well because it'll get a bit extended beyond the mean. Markets don't like the unknown. They don't like surprises. So we've seen really swift response here. As more data comes in and more is known, it's likely that we're going to see a lot of this just unwind. So this, of course, has the potential to turn into something really negative that lasts a lot longer, but that is not the base case scenario. So if you had shorts on, great, right? You'd be able to monetize, but I wouldn't try loading up with a lot of shorts expecting that this is going to continue to get nasty. Nothing wrong with a lottery, of course, right? Put on, some small positioning if you can find something with some decent pricing. Because what I mean by that, if you haven't figured it out yet, when it comes to something like options, try to get in to go short when everybody else is trying to get in and go short. You're not going to get any good prices. Small caps down the most at 1.5. Then the Nasdaq down at 1.25, the S&P and the Dow down 1%. UK only down 0.25% with Hong Kong. Japan actually in the green, up 0.5%. Nice. We're going to get consumer sentiment this morning, but the numbers are not very far off. Not expecting anything to be out of line. A couple of ECB members chipping teeth. The afternoon should be really quiet other than, surprise headlines or something like that. So we broke through the 10 after bouncing on it yesterday, developing it as a support level. We broke it last night and we went down into the 20 period moving average. Now we're sort of pinched between the two of those moving averages. We have the 10 over our head with the 20 underneath us, maybe a little bit of ping pong back and forth. We've also got zero gamma and volatility trigger. They're not perfectly overlapped, but they're close enough. The 3-week and the 20-day moving average are on top of each other. So we got a lot of things all wrapped up into this small zone here. The IX10 or the sideways range has finally ended, obviously. And the next bit is going to be, well, what's next? take a look at that candle right there. And that candle right there. Kind of get the idea, right? Now, we don't know that that's going to be the outcome, that the next candle we get is going to be that big green bar breakout. We don't know that for sure. It could continue to the downside, or it could just go sideways from here. My point still remains the same. Don't get all bulled up and jump to the downside heavy with both feet. Just don't. You're very likely going to regret that. Find some shorts if you can find something appropriately risk. Otherwise, not a good idea. Overnight volume 153. We've been running at around 50 to 65, 70. So you could say this is nearly double the overnight volume that we have been seeing recently, which makes sense, right? We're getting more participation in the overnight. It brought in more eyes. And when we turn on the profile, we'll see where this volume was allocated in the overnight. Even the initial balance was, fairly wide, all things considered. So at this point, if we do continue trying to drive back towards where this all started, that would be the gap close 60.32 cog line. And to do that, we have to get back inside of yesterday's range and keep it. This is yesterday's range. So we're in there. But you can see we're really struggling here. 59.92 cog line, and we are there. 10-day moving average. Everything is just right on top of each other. So, like with yesterday, when we got back inside of our own Globex, and I had mentioned that we really needed to keep that. And we had gotten back inside of the previous day's range. We really needed to keep it. It's kind of the same thing today. We are working our way back inside of yesterday's range. And at this point, we really want to keep it. We don't want to see it break down back below yesterday's range. So getting back up here to the start of this move would be a gap close 60.32 cog. We can also focus on the midpoint of all of this. So the Globex low and the Globex high, you can see the midpoint really close to where we are now. And again, it just highlights how everything is stacking on top of each other here. So get through the mid and keep it, get through the 10. We have the 3-day moving average here, and then we can get the gap closed. Getting that gap closed does not make all of this move a bullish move. This is just trying to close the gap. After we get it closed, we then have to evaluate what's price going to do next. Did it just go back up to get the gap closed and then it's going to continue to the downside? Or did the gap down end with the violence down here and we've just been working on our way back up again? We won't know that until we get back up there and see what price does after it gets there. There's an old phrase, first we bounce, then we break. Well, we bounced the 20. If we fail here and start to drop back down, 20 is the target. Under the 20 is the 200 period daily moving average, which also happens to be 5,900. Nice round number. And if that doesn't hold, 58.32 cog line, which is the 50 period daily moving average. It's not that far away, right? 58.32. It's like 160 points-ish. As expected, we have a market maker move this morning. That's not necessarily indicating that there's something ahead of us. It could be just a response of what had already happened. Keep your eye on it through the morning and see if it continues to widen or if it's shrinking and reducing itself. It will end by the end of the day, right? It only has a 1-day life cycle, so it won't survive the day. As we get into the afternoon, it will shrink anyways, simply because it's running out of time. The normal thing that we say about these ADR lines is if we get to one side early enough in the day that we can go to the other side by the end of the day. And while that tends to be true quite often, this is a little bit of a different situation. One, we didn't just get to the red line early in the day and then, have a chance to go to the other. We went to the yellow plus some, and we extended nearly the entire distance between those two, even further in the same direction. Not quite, but pretty close. So it's extreme. Just getting back to the full ADR or the ADR half and hanging out around that line, even hanging out within these two lines would be appropriate, right? Between our own Globex low and that ADR half. If we spend the rest of our day right there, I think the markets would rejoice on the recovery that we got so far and be pretty happy with it. So I would not look to get to this other side by the end of the day. Now, having said that, if we get the gap close and we continue to go to the upside, then it's just target after target, right? The gap close is our upside target right now. Get through that, we got Globex high. Get through that, we have yesterday's high. Get through that, we have the high on the week. Get through that, we have the ADR half. Level by level by level. We just run it like we run everything else, one level at a time. It's maybe a little bit of a tinfoil hat, but all week been saying it was going to be a sideways week, especially through Monday and Tuesday. We could see that there was a reason to be sideways. We couldn't figure out why. The big assumption was it was probably CPI or one of the auctions, 10-year, 30-year, and yet those came and went, and we were still sideways, still stuck trying to figure out why. What is with this sideways range? Now we know, right? Maybe this wasn't a surprise, right? It's not like nobody saw it coming. So I think this sideways range for the week was in preparation for the news that we got in the overnight last night. And like I said, tinfoil hat, maybe yes, maybe no, right? Either way, the sideways range is done. We finally ended it. If you don't have Thinkorswim or you don't have this indicator that says market maker move, go to the futures product options. And what you want to look at is the options that are going to expire today and the next expiration out. So here's the 0-day, and then here's Monday. When the implied volatility average in the front expiration is higher than the next one out, it's called a market maker move. Thinkorswim just made it up, right? So if you haven't heard of it before, but you've never used Thinkorswim, that would be why you've never heard of it before. Having said that, just the fact that they made it up doesn't mean that it's irrelevant or not useful. It's really useful. It's how we can identify that they're hedging. And of course, they're always hedged, right? They're always hedged. This is additional hedging. It's like having homeowners insurance, hearing there's going to be a hurricane, and then you decide you're going to get added hurricane insurance for a 2-month policy. It's just extra insurance. So we can tell when they come in and they pile in with extra insurance. And if they take that insurance back off today, we'll see that too, because the market maker move will decrease. This is also the last day of these contracts being traded, at least by most of us. when you come in next week, we will be on the U series. For those who trade futures and your broker doesn't roll for you, you're going to need to auto roll. If you use TradingView, be careful. It will change your contracts for you. And in fact, TradingView a lot of times will do it early today. It won't wait until Monday, but Thinkorswim will do it by Monday. So that's how you can spot the market maker move if you don't have Thinkorswim. Just look at the implied volatility average. If you want to know more about the market maker move, go to the Schwab website or just Google market maker move. It'll take you to the Schwab website. You don't need an account there to read the article. And if you want to use the internet's go back, then TD Ameritrade has like 12 articles, had 12 articles back in the day that you could read. Today's floor pivot is lower than yesterday's. That's bearish. Price opened above it. That's bullish. None of that mattered in this context because as soon as we had the news, we broke it and dumped all the way through the weekly floor pivot. Now we managed to get back above it after testing it a few times. And once we got back above it, we validated old resistance as new support. Call that a Busby. And now we're outside of that channel. And so far, we're holding above the half to work our way back up there. If we break the half, the weekly floor pivot is the target. Get through that. We can get through the channel's low, which is also like 59.50 big options level. And through that, through the Globex low. Then yesterday's 111. Well, in this case, I guess it'd be Globex 111 and the 1236. Level by level, we'll work our way back down. The channel's wide, which implies that if we break out, that it doesn't stick. I mean, so far, we've managed to get back inside the box, back inside of yesterday's range, but we need to keep it. And right now, we're just barely inside the zone. All right, so it's not exactly the classic profile, but you can see the distribution through most of the week. That's the sideways that we've been dealing with, that we've been anticipating. Then the tail from the breakdown and now the run back up. What's interesting is we don't see any big footprint down here from the reversal, right? So it's not like they came in and placed Save-A-Ho down at the lows. At this point, getting back inside the value area low would be a bit of a stretch, but that's 60.11 cog line. And above that, we can begin to gravitate towards the week's point of control, 60.32 cog line. Ten-day, 30-minute volume profile and TPO, there's nothing classic about this shape. It's just a mess at this point. High distribution nodes all over the place. Point of controls line up, but really that's about it. We're going to continue to wipe this volume out from the lower part of the chart. And since we've been mostly staying in this zone since then, unless we get out of that, we're going to have a very narrow distribution next week. Looks like 120 points-ish. Gonna look about like that. It is interesting how far we dropped in the overnight last night, lining up with last week's Thursday and Friday. So again, we need to keep that 59.32 cog line. And 60.11 right now is the line to get through, get above. We don't see this point of control moving very much. It can go to one of these other two zones. Obviously, we can hang out down here and bring the point of control down, or we can get above our current point of control and we could put in some work up here and move it up. But really, it's not going to move much, right? 60.50 or 59.90 area. Yeah, like they didn't know, right? Could see the work put in right before the drop. So we do have the point of control down here. If we can't keep it, got a reasonably decent distribution. This area stands out quite a bit considering we didn't really spend very much time there as opposed to how much time we spent here. This is where the point of control is. And we were there from 8 o'clock last night until 3 o'clock this morning. So 5 hours. We were in this spot for 3 hours. And it's almost the new point of control. So they were putting in a lot of work at that 59.80 area. It goes with the idea that we really need to keep this inside now that we're back inside of yesterday's range. We really need to keep it. All right, we're back to the 10-day, nothing there. You can't see it unless I really zoom in, but there's a tiny little nub down here. So we're at the 10. We're still more than 2.5% above the 10-week. The 10-week would be the mean. We're still above the mean. We're still in a healthy, bullish environment, strong environment, healthy, clean. There's so many other ways to say it, but we're not broke down. Even with this reversal, the negativity of last night, it didn't break anything. The trend is still there. We don't have any momentum, but from a swing trade perspective, being this far above the 10-week and having that tail underneath us from last night, there is no downtrend. We need to start setting lower highs, lower lows. We'd have to, turn the distribution around. We don't have any of that at this point. We did tag the edge of the weekly expected move, and we managed to hold it. We have an example of next week's range at this point, and even without even putting a box on it, we can see that it's a wider range. Now that range is not set in stone yet. It's going to continue to move through the day today. And after the close tonight, it will lock into place. And then that'll be it. So we can see how this week's range compares to next week's. And just to add a little bit to that, next week's a short week, right? So this wider range that we see next week, it's only calculating 4 days. Generally speaking, less days means less range. Think about your car with how many miles you can go, right? you can go X miles and then how many hours. But if I take one of those hours away, then how far you can travel is reduced. These ranges are developed based on time and volatility, time being how many days. So the week that we just had is a 5-day week. We're comparing that to next week, which is a 4-day week. It should be a narrower range. The reason it's not is because volatility is in there, because there's only two ingredients, right? Volatility and time. So there's a lot of volatility priced in next week. The fact that it's wider tells us there's a lot, but it's wider and there's a day missing from it. So it is significant. This wasn't priced in the odd sense that if it was FOMC, which would also be something, that's a headliner, the market would be worried about it. It would be something we would expect the markets to be causing with volatility. We'd actually get a narrower week. So when it's known unknowns, we get those narrower weeks. It's why this week we were able to anticipate that Monday and Tuesday was going to be sideways days, because this week that we're in was such a narrow week compared to the week before, right? So the market's just straight up pricing in volatility for next week. Well, gold miners are up and energy is up, as we would expect, right? I mean, we've seen commodities and the moves in commodities last night. So it's not a surprise that those are the markets that we have this morning. When we look at what's down, nearly everything else, right? So between those two groups, what may be worth looking at are the things that have not moved enough to meet our qualifications. And the qualifications that I use is that it needs to be down or up at least 0.5%. Nothing really in there that would help us out. So at this point, we're going to want to keep our eye on the three sectors that we really need: consumer discretionary, financials, technology. Now, those are vague. So rather than just quote finance, keep your eye on the banks. Rather than just tech, keep your eye on chips and cloud computing. And for consumer discretionary, yeah, that one can spread out into all kinds of stuff. Just look at the Mag 7, basically. If we're going to turn around and run this back up, it'll be either from headlines, 0-day options flows, or the Mag 7 and or a rising tide. We're not slipping into contango or anything like that yet. We're not slipping out of contango, I should say. So that would be something else you want to look for today. The VIX is up a little bit. We can see that, right, with the spike, but it's giving it most of it back already. But that's just really short-sighted. You can use the VIX if you if you don't have futures, but turn on the VIX futures and you can see the dates. Contango implies that the things that are in the front month that are going to expire soon are cheaper than things that are farther out in time. Right? So this is $22. This is $20. This is the volatility curve at the moment, and that's contango. Should this change and we get into the other situation, backwardation, then the things in the front are going to become more expensive and the things farther out will be less expensive. And it'll be shaped like that, backwardation. If you don't have the VIX futures, there is symbols that you can use from an equity perspective, like VIX 1D, 9D. The regular VIX is 30D. Then you can run, I think there's a 3-month. Yep. And then a 6-month and a 1 year. So just keep using numbers behind the VIX and you can line out a lot of those ETFs or ETNs. 1 day, 3 months, 6-month, right? 1 year. You can stack them all up, and that can give you some perspectives on VIX over time. Show you contango and backwardation. Too early in the day for that nerd stuff, huh? Airlines are down the most, oddly, out of everything going on. Wouldn't expect that. Uranium right behind it, solar, and then chips. Out of all of that, chips down behind everything else. Then China, Bitcoin, China again, and China again. Small caps, consumer discretionary. Then the Mag 7. So, putting things in order, the things that are down the most are not really things that would impact the market. Like jets, we don't rally or fall because of jets. We don't rally and fall because of solar. So those are not an issue. Now, SMH, the chips, that's an issue. And Bitcoin is an issue. So keep your eye on those two. See if they can jump the herd and start getting worse, or if they try to come back. They're not really trying to come back yet. Not a surprise either that chips and Bitcoin have the same look this morning. If you look at the chips watch list, AMD, NVIDIA, they're in that list, right? All right, so let's wrap this up nice and easy. This is the box that we're dealing with. It's yesterday's price. We're back inside now, and we need to keep it. A lot of days, we're talking about GTFO to do something, right? Get out of the box to play. Today, we need to keep the box. We want to stay inside the box so that it doesn't get bad. So if we get out of the box at this point, I think it could get bad. Level by level, run it back down. And for a stopping point, oddly enough, the market likes those percentage values with consistency. So if we break back out of this box and start heading south, check things out at 1.5% to the downside. And then if we pass that, 2% to the downside. And if we pass that, then start running quarters, 2.25, 2.5. But until we get to 2%, run it in 50s. So 1%, 1.5%, 2%, and then quarters. It's just the way it is, right? It's just odd. Now, the other way around, if we're going to keep this drive to the upside, then play it the same way, level by level. We got that half to get through, 60.19. And then we can get back to the gap close and on up, right? It's really a simple day, all things considered. One thing that's really going to be difficult is, on a typical day, if we are still inside of our own Globex range, say like this day back here, then it's GTFO. All we got to do is get out of the box. And if we don't get out of that box, then we really don't have a trade for the day. We just trade something else or put on some credit spreads or something. Just leave it alone. We're inside of our own Globex. We're in the same situation right now, but the range is so big that we can actually have a really wide trending day or really wide trending price through all of this nasty mess. But if you're going to do it with options, be careful because the premiums are going to be all out of whack. Everybody be careful, be safe, have a good weekend. And I will see you all next week.